Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Pool Lock YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question from Jamie. We're planning for our retirement and I feel like we're prepared for all those different factors. The one thing we're worried about is taxes going up because I can't control it. What do you think we should be doing? All right, Jamie, so I'm assuming this is a couple question, right? But you're right, that's one thing that you can't totally plan for. I don't know if you've listened to some of our other videos, right? We talk a lot about how people are concerned about a lot of these things, and there's some things that they shouldn't be. You know, if they're living off the income, you're okay, the interest and dividends. Because again, now you're not so worried about bear markets, right? You're not worried about recessions very much at all. If you plan in advance, if you've covered the medical part of it, all that kind of stuff, if you've done the things that I've talked about in the past, sure, then you've covered the inflation part, but taxes are absolutely the wild card. And this is especially important because tax rates are historically quite low right now. And there's a real possibility that they could go higher in the future. So the best thing you can do is be tax diversified. Just like we want to be risk diversified with your investments, you want to be tax diversified across different types of accounts. So what do I mean? Well, you have taxable accounts where you pay tax on the interest and dividends every year. But withdrawals on those principal amounts are usually tax-free because you've already paid taxes as you go along. Or maybe you'll have a little bit of a capital gains tax, which is typically at a lower rate than ordinary income tax rates. Then you have those accounts that are tax deferred, the 401ks, traditional IRAs, where every dime that you pull out in retirement is taxable as ordinary income tax rates. And here's the thing, right? When you're required to take that mandatory distribution starting at age 73, you have no choice in the timing of the amount, right? The IRS is going to force you to take that money out and pay taxes on it whether you need it or not. And then you have those things that are tax-free, like Roth IRAs. So withdrawals are completely tax-free and there's no required minimum distributions during your lifetime. This gives you incredible flexibility in managing your tax situation year by year in retirement. So again, you want to be diversified across all three tax treatments, right? You want some money in regular taxable accounts like brokerage accounts or bank CDs where you're paying tax on the income as you earn it. You want to have some money in tax-deferred accounts like those 401ks and traditional IRAs, 403bs. And then you want to have some money in tax-free accounts like Roth IRAs. The beauty of this approach is that it gives you options. In lower income years, in retirement, maybe you take more money from the tax-deferred accounts. In higher income years, you might lean more heavily on your Roth accounts or your taxable account, right? You can actually manage your tax bracket somewhat by controlling which buckets you're pulling from. So as you're planning, the best time to do this tax diversification is probably right now, while you're still working and have time to build up these different buckets. Take some of maybe your newer contributions, put them in after-tax accounts or put them in Roth IRAs instead of just traditional retirement accounts. Now you can diversify yourself better if you're currently lopsided towards tax-deferred accounts, which frankly most people are because that's where they get the immediate tax deduction. Now if you're really close to retirement and you don't have a lot of time to build up that Roth bucket naturally, then you need to look at some Roth conversion analysis. This is where you systematically convert some of your traditional IRA 401k money to Roth accounts, paying the taxes now at today's rates rather than potentially higher rates later. The key is doing this strategically, maybe in lower income years or spreading it out over several years to avoid kind of pushing yourself into higher tax brackets. And here's another thing to consider for your income planning. Different types of investments are taxed differently when within your taxable accounts, right? Qualified dividends are taxed at those lower capital gains rates, while interest from bonds is taxed at ordinary income rates, right? So even your asset location strategy, which investments you put in which types of accounts, can help optimize your tax situation and maximize your after-tax income in retirement. A little complex, but a great question. Thank you. If you would like to send in your question like Jamie did, you can do so by emailing them to poollock@poollock.com. Now, our second question is from Kevin. If inflation continues to go up with all, the tariffs and all that kind of problems going on, will I be able to lock in higher interest rates if I just wait a while? Well, this is an interesting question, right? This is kind of the other side of most questions that we get and talk about on this show. Instead of trying to time the stock market, now we're asking, can I time the bond market? And, it isn't really me kind of poking fun. It is a great question. It's just unusual. But it's still a form of market timing. And that's where we need to be careful, especially for those of you kind of focused on retirement income and stability. All right, let's think about this logically. When do you want to refinance a mortgage? When interest rates are low, right? That's obvious. But when do you want to, refinance your investment portfolio to prepare for retirement? Well, when interest rates are high, right? That's when bonds are paying better yields and income producing investments are essentially just more attractive to, purchase and get involved in right now. So your thinking actually makes a lot of sense, right? You're looking at rates and wondering, should I wait just a little bit longer? See if I can lock in, something a little bit better, right? And yes, rates could go higher. But let's zoom out. And we want to zoom out, kind of look at the bigger picture. For example, 10-year Treasury has been hovering in the mid 4% range recently, right? It's been kind of sticky, holding steady, and it's in that range for a while now. So sure, if we saw a surge of unexpected inflation or other, shocks, right, rates could edge up a bit. But several factors suggest we may be closer to a ceiling than a new floor. Now let me kind of let me elaborate or explain on that kind of floor and ceiling situation. First, regardless of political views, we know presidents in an election year care about market performance. The current administration has taken a lot of credit for market gains. Right? Historically, higher interest rates put pressure on the stock market. So there's incentive at the federal level to avoid letting rates rise too much, right? Too much higher, especially in election years. Second, and again, this is critical, the government kind of has its own interest rate problem, right? We're running about a $2 trillion annual deficit, and a growing portion of government debt is coming due. If rates stay high, that debt has to be refinanced at much higher costs. The longer rates stay elevated, the more expensive it becomes for the federal government to operate. That's yet another reason why we're likely closer to the top of the interest rate cycle than the beginning of a kind of new leg up. So where does that leave you? And really anyone else asking a similar question of, hey, can I get a little bit higher interest rate? If you're nearing retirement and you're thinking about locking in dependable income from bonds or fixed income investments, I'd really go ahead and say this. Don't try and guess the top. You might get it right, but if you do, it's luck. And timing luck is not a retirement strategy. If your goals include stability, capital preservation, reducing volatility, right, as you head into and through retirement, then now is likely a very reasonable time to begin making that shift. You don't have to go all in at once. You can begin layering in bond ladders, dividend stocks, fixed income ETFs perhaps, or even income annuities if it's applicable for you. The key is this: make the move because it fits your plan, not because you're trying to outguess the market. That mindset, choosing safety and predictability over speculation, is how retirees protect their future income and sleep well at night. That was a great question about picking the top of the interest rate market. Just remember, it is just guessing in the long run. If you can lock in your safety and income now, do it. Great questions. If you would like to send in your question, you can do so. You can email them to poollock@poollock.com. And if you like what you heard, go ahead and like and subscribe. I'm James Locke, your retirement income source, and I will see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.